what happens over there? Why is it so difficult? Because it's very hard for some people to understand. So, well, all the papers are here. Why is it so difficult? Like they don't understand that there are times when you would have done an underwriting, you have started off with the process, you're raising the capital side of things, but then still underwriting still continues happening. There are changes that keep happening. There is an underwriting that happens during the process, and then after the close, there is another one as well. Hello, everyone. This is Sanjay Hegde, your host from REI Secrets Field, Fast Track to Riches. Today, I have a very interesting, a very important person on our podcast. He was very gracious because I've been chasing him for the year and a half to get on my podcast. But finally, he did take the time to get on our podcast. So I'm very blessed to have him. He's a person who doesn't need any introduction, especially in the real estate world, especially in the multifamily space that we are in. He's known for his kindness. He's known for being an entrepreneur. He is, always helping. I don't even know what to tell. For me, he has been a guide. I've been his greatest and the best Uber driver you can ever find, and he enjoys driving around with me, and I get to learn a lot with him. That very much, if I say, you would probably know who that person is because everybody knows me as his famous Uber driver. So, ladies and gentlemen, I give you Jim Stewart. So welcome to REI Secrets Spill Fast Track to Riches, Jim.
Hi, Sanjay. Thank you for the the great welcome. And yes, you are the famous Uber driver that seems to doesn't matter where we are, right? Whether it's Atlanta, you drive over to there because you're in North Carolina, so that's not too far. But what is far is when you pick me up in Dallas or somewhere else, Austin or Houston. I mean, that is a long drive for you. Although the one time, Sanjay, it was funny, right, where I was expecting you in your car, and you came in a rental car, and I'm going, "Where's Sanjay?" I'm going, "Where's my Uber driver?" And he's in a different car, so it really surprised me. And we hopped in. I said, "What happened?" I'm thinking, "Oh, maybe you broke down and whatnot," but in fact, you ended up with a flat tire, so it was just better for you to fly. Yeah, and the flat tire was close to your home. So yeah,
Yeah,
but yes,
yep.
thank you for having me on. That's I'm very appreciative of you inviting me, and I do acknowledge it's taken a while to wrangle me in.
I know that you're a busy man, so Jim, pretty much, I know that you need no introduction, but would you like to tell us a little bit about yourself? And we'll definitely get into the journey of how you started off in multifamily, but it would be nice to at least get to know the person, but you speaking about it yourself.
Sure. Who is Jim Stewart, right? Sure. Happy to do that. Well, Jim Stewart is a Canadian. I actually am in right now Winnipeg, Manitoba, Canada. This is where myself and my family live. Though I spend an incredible amount of time in the U.S. Because that's where the real estate, the multifamily business is. But we have lived in Canada our whole lives, and I'll just say one of the key decisions when we came to the US was for investing purposes. I said, I will not invest snow to snow. I want this to be a lifestyle choice, right? I'm going snow somewhere warm. So in the wintertime, I get an escape. So I'm highly motivated to go down there. But my wife and I, we bought our very first multifamily September of 1991. So essentially, you're looking at 34 years ago. It's crazy when you think about it because it doesn't seem that long ago. But that was the start of our journey where we bought that apartment block. We moved into it, and we learned firsthand because we managed it. We renovated it on weekends and evenings. We were both working full time in our professional careers. And but it was a great experience to start our journey, and that forayed into kind of like where we are today. 2000 2014 started looking in the US, Canadian market had changed, and Canadian market's like 1/10 of the US market. So we wanted more opportunity. And so by going into the US in 2015, that allowed it. Well, that's when we first bought in 2015 in Atlanta specifically. That allowed us now to open up into a much bigger market, a lot more for what we do, which is value add sort of style, lighter turns, lighter renovations, although we do the heavy reposition too, which we can talk about as well. But that really opened it up for us. And here we are 10 years later, still going at it in the US and a lot of different markets, which we can cover off later. But that's what we do. And also, we're both professionals, and I was fortunate enough to be a partner in a manufacturing distribution company. Plus, I had a couple of other companies. So we had a lot of things going on. And my hobby was real estate, quite honestly. People say, oh, you must have did this full time to achieve what you've done. No, I did it part time. It was only when in 2019, at the end of the year, when I retired, did I say, okay, I'm going to do this full time. But when I was younger, I did golf a bit, but I gave up the golfing, and I basically would do this. Is what I enjoyed. And well, that, and you can see behind me, I don't have a screen on like you, but I've got cars up there, and I'm a big car lover. So I love my cars, classic cars, exotic cars, that sort of thing. So yeah, but that's a little bit about me, Sanjay.
Awesome. No, it's always fun to hear about how you started off, and uh, I get to spend more time with you because we drive around so much. It's always so much to hear about the things that you do, and what you like doing. I know you love going to Vegas for the car shows. The love for the car and so on. But you said that you've been doing business in the U.S. for the past 10 years in the real estate. Can you tell us how it has changed over a period of this 10 years, and how you've been managing to meet the change, and subtle changes are happening, but you have the tendency of you know making those decisions as to now is the right time to take this step on this particular property, or maybe I don't want to go for a bigger property, I want to go for a smaller property, and so on.
Yeah, no, very true. I mean, certainly, it's been interesting, especially when you're in it over 30 years. You get to see these different cycles. And so you've got it in the multifamily side, but also on my other side of the business as well. So we're seeing these cycles go on, and there's no question you have to look at the cycles, and you may want to be in, or you have to adjust your strategy, one of a couple of things, in order to survive. So right now, I'll just say, when I got involved, there was a cycle going on in the US from 2010 to about 1819. And during that cycle, it was very, very active. It's like having a barrel full of fish, quite honestly. And that barrel was full. You could just pick a fish and you had a winner. Pick another fish, like you didn't have to look hard. It was just around you. And back in those days, you didn't really need much skill in order to do what you needed to do. You could just get lucky, and you're riding a wave basically through that. And so because of that, we had a lot of people buying properties and a lot of feeding frenzy. And then what started to happen is, with all that competition, it's like, if you use the barrel analogy again, the barrel's emptying out. It's getting lower and lower because there's so many people entering in. There's still a lot of product there, but you've got that ability to still find a deal, until finally around that, after, call it 1819 range, it really started getting slim pickings. And so, using the barrel analogy again, it's like there's very few fish left. And so over the last 4 or 5 years, it's been really difficult to find deals. As you know, we have been, because we've really worked hard at our broker relations, but it has been hard, no question about it. But you differentiate yourself by finding those deals, and if you can execute well. I'll just also say that a lot of people, so you wanted to know about strategy wise. Well, we were buying larger properties, and so we were buying 100 doors and above. So in the first year As an example, we were involved with a 242, a 250, and 118 unit that we bought. And then basically the next year was a 200, a 212, and a 236. And we kind of kept going like that. So you could see the size of the deals we're doing. Those were pretty good deals to do, good sizing. But as we went along and interest rates started continuing to go down, and so when interest rates go down, the cap rate typically goes down as well. And when the cap rate goes down, it can imply a much higher value potentially on the property. And so we had even more and more people taking bigger risks because they felt there was a lot of upside and they were underwriting differently. Historically, you should underwrite to 10% vacancy, but back in that era, 5% was the norm and virtually no delinquency. Sometimes they're trying to underwrite at 96, 97% occupied. So 3 to 4% occupancy. Well, that's really, really tight because, as you know, Sanjay, because you're a partner of mine, when we turn it over, there's a certain lag. We have a person move out, we've got to renovate it, and then we got to re-rent it. Now, in a hot market, it may re-rent really quickly, so it can happen all in the same month. So you don't have a lot of time. In a slower market, it expands. It can take several months for it to happen. So in this case, as we changed and it got hotter and hotter, we had more people feeding, and that's when I started selling a lot of these properties because we were getting 10, 12, in one case, 21 offers on a property. And we were able to hit, so we underwrite to 100% is our goal. So once we hit 100%, we'll exit out. And we have a certain component of that that's cash on cash as well. So it's a mix of two, where it's cash on cash and then the balance is at the back end. We were hitting it in 3 years. We had 240 Flint River. We did it in just over 2 years where we hit 100%. And that's how crazy it was. And we also had the perfect storm of a lowering cap rate to increase the value. But we had these people buying it. And when interest rates got a 3%, 3.25%, it just became too hard for people to resist because they said it was cheap money. But we stopped buying and of the big properties, because what you have to understand, and you know this, Sanjay, but I'll just say it, is the underwriting was where they were taking 10 basis points per year. So bridge financing became more favorable than agency financing during that time period, and which is an anomaly I've never seen before. But the reason is with bridge financing, you could get a high percentage leverage, which you could get with your traditional agency, Freddie or Fannie or CMBS, but they were also willing to lend you 100% of the capex. So it's highly levered product, really, at that point. And the interest rates were reasonably favorable. The other component to it was they required you generally, because you wouldn't get a fixed rate, you'd have a floating rate. So you'd buy a rate cap to protect yourself for a certain amount of time. And they had an underwriting formula that would determine what percentage, might be 1, 2, 3%, depending on the type of deal, that they need a cap rate on it. So that if, say, it was 3% and you borrowed the money at 3.5%, the maximum interest rate that could go up to be 6.5%. So that's all happening. But then we've got this whole problem of the underwriting on the backside, because you got to exit out of these things. And generally the plan was you'd either exit out to sell it or you'd exit out to go into a more traditional agency loan, which would be Fannie or Freddie. And so they were underwriting to 10 basis points per year. So in other words, if it was a 3 cap, which Dallas-Fort Worth, Phoenix, Austin, these markets were hot. They were all the way down to that, and some actually, in some instances, below that. And so they would be like 3.3 on the exit. So what happens, though, is people know, because interest rates are up higher, interest rates started going up. And so that blew the whole thesis of their exit. And of course, the interest rates are higher. Now they got to refinance at a higher level. But if they've only got 3.3 or 3.5 as their exit cap, and caps have now gone up because of interest costs to 6, 5.5, 6, 6.5, it takes a lot of money to compensate for that. And we also had the forces of insurance, and we had the forces of taxes going on. And And then we also had high, like big growth in the rents, but then they pulled back in a lot of markets because the new builders, all the new stock was being built up, and so they had all this cheap money too. So we had an overabundance of new product coming in, so we had too much supply. And then, of course, everyone's fighting for the tenant, and down goes the apartment rents. So we, looks like we were brilliant now, but at the time, it just seemed the right thing to do is to step aside. And as you know, because you're involved in these smaller projects, we went sub 100 and started buying those because the cap rate wasn't affected the same. And we could have a different style of underwriting. We also didn't have all that money chasing it the same way. We had institutional, wealthy families. I mean, there was so much money chasing the bigger deals. It was incredibly competitive. And that's why you were getting 10, 20 offers on this. And so it all of a sudden even drove the price higher, which meant drove the going in cap rate lower. So basically, we went into the smaller product and we were repositioning them. We generally did a light value add, although we did get in some heavier reposition, right? Whole, like a heavy reposition is when you go in and you do a lot of work. And so in the one case that we had out north of Austin, we took it right down to studs essentially. So now you're potentially doing wiring, plumbing, you're putting drywall back in, you're putting new cabinets in, new windows in, new flooring in, new bathtub, like all that. And so that's a heavy lift. I prefer to do the lighter lifts, but we did some of those in there. And then over in Chattanooga, as you know, we did one there, smaller property, and we renovated. We put new kitchen cabinets in and changed out the flooring and the lighting and whatnot. And but what we were able to achieve, we did bridge and we had a rate cap. Um, I chose to only go a 0.5% rate cap. People thought I was crazy for locking it in, but it was very little money. So on the small bridge loans, they charge a premium compared to the big ones. So, for instance, on that particular instance, we were at 5.5%, but we had a half a percent cap. So the max our interest rate could go would be to 6%. So we were X amount over the SOFR. And then as the SOFR went up, you would continue to go. But because we had this top, we could only go to 6%. So the irony of it all is when we went to refinance it, we refinanced at 6% with agency. So it was the same interest rate essentially, but we created so much value with that market in that segment because of the competition and the being able to buy right, the lack of competition. We were able to refinance it out and give everyone their money back, right? And that's the
That's
proverbial
awesome.
home run, right? At that point. So that home run, then you've got your capital back. Now it's rate of infinity. Everyone still to this day owns their interest in it. So they've got equity in the property. And then as you rebuild up the cash flow, because you've refinanced it up at a higher level, it takes a hit initially on cash flow, but then through time, you'll get more cash flow back. So that was our strategy. But now in the last 2 years, we've gone back into the bigger product because it's like the barrel is starting to get a few more in. Or if I was to use the wave scenario surfing, we were during that 2010 to 18-19 period, it was like the big waves, where you have the surfer and he's in the crest and he's ready. Like that's just like you got these beautiful waves and there's another one coming. And then we went into a period where we had a lot of the waves retreating back. So you're in that water where you're being pulled out. Well, that's where I talked about all these people getting caught where they bought really cheap. And when I say cheap, I call it cheap, but they thought they got a value buying it at a 3 cap or whatever, and they had very low, what I call low interest money. But then their rate cap went on them, and it went up, 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 and those that didn't buy it really got in trouble, and they couldn't unlock the values. So now they're in that turbulent water. And the last 2 years, we've been kind of like a calm sea, right? It's been very calm. And for those of us that have great broker relations, which I can talk about how you get those, that allowed us to find the needle in the proverbial haystack. And by finding those needles, you're not finding a lot of deals, but when you find it, they are generally great deals. We've done some pretty fantastic, we've found some pretty good ones. So we're buying the 200 plus or 100 plus, depending where we are. And so now we're back because I think using the waves still, we've got a whole bunch of waves starting to come, right? So it's starting to build again. So the market's starting to come because we had sellers here, buyers over here, and now we're starting to see them meet. And some of it is being forced by the lenders saying, you guys are upside down, you need to deal with it. And others are just saying it's time to sell because it's been years now and they're just accepting that this is what they're going to get, time to move on. And so I think 2026 is going to be a great year for all of us. So we're going to be buying bigger products, value add.
That was great, Jim. And the thing is, it was a great strategy. So one part of it is the strategy, and then obviously underwriting is a big part of it. But then again, underwriting is one just just it's just the tip of the iceberg, right? Because the fun starts after you buy the property, because there are so many things that happens, just like you said, waves. There are turbulences that happen in the ocean when you're and you got to navigate that ship. Sometimes I think at all times it has to be, the navigation has to be pretty tight. If not, you're going to hit the shore, or some of those things. So can we dive in a little bit more into the operation side of things, as to what are the
Yeah,
things?
sure. We can do that. Or if you want to talk about acquisition, like how do we go look for them and stuff, and then go into
Uh,
operations, whichever
Absolutely,
way you
yeah.
want to go.
Okay, so let's go with the acquisition, then we'll go to the operations.
Sure. Yeah. So with acquisitions, I mean, I'm of the philosophy you make a lot of money when you buy, if you buy right, and if you buy in a great location. So part of it is, as you know, we like to look at a lot of stats. And we like to see household formations happening at a positive rate. We like to see population growing at least 2% per year and wage growth going at least 2%. By having that, you have momentum in a market. So if wages are going up, then organically the, the rents can generally go up as well. We're looking for investment in the business community that we've seen. The one property that we bought that I mentioned was a small one there where we were able to refinance. Everyone was in Chattanooga. So Volkswagen announces they're going to have their plant as the electric plant for the cars, electric cars. That's huge, especially in a market of only 200,000 people. They're investing well over $1 billion. And then a major parts company comes in and says, hey, we're going to invest over $500 million into our facility to help support it all. And then there's all the spin-off effect. And one thing I didn't know when I first looked at Chattanooga is they have incredible bandwidth there. So all of a sudden you say, wow, so now they got a lot of tech coming in there. So there's a lot of positives in that market. So we look for that plus those other metrics. And it's got to be a large enough market that you've got an airport there, you've got a major hospital, you've got a major school, and so you've got the basics to support it. So it's got a really good nucleus, and you've got at least 200,000 people. And so we look for that, and when we find those, and we find deals that are in a path of progress, which means there's something happening with that area, or it's in a C area, but it's a good, safe neighborhood, and maybe it's a C property. So for us, a C property means workforce housing. It's the mainstream of all of the US. I mean, they do have higher product. You've got your Class A, which is very nice product. That's the most expensive. And then you got your B that's a little bit more tired, but still nice product. And then the workforce housing. And we buy and play in the workforce housing and the B market generally. We we find when we're in that market, we've got headroom to grow. And if the market goes bad, the A's get hit first. And then, so the A people end up moving into the B's, the B people move to the C's. Unfortunately, the C people move into the D's, and, it kind of keeps going down like that. So it allows, us to be in the middle. So we're always good. And even if the A's discount their rents, we still have enough room between the A's and the B's to protect ourselves so that we're not affected if we've got a great product. So when we're looking for that, but we also broker relations. As you know, we buy everything through brokers. And so we have created a lot of great relationships with a lot of, but the key is, I'll say, Sanjay, for me anyway, it's been always you find the people that you have commonality with. And so it just seems natural, whether, like I mentioned, the cars, there's one commonality. Travel. It could be a lot of different things that you have. It could be kids and sports that you're doing, it could be golf, all these things. And so you have that commonality, and that's what starts to build the bond, the friendship. And you also, if you're starting off, you have to really differentiate yourself. So a lot of people are phoning brokers, as you know, and if you don't know the language, they know that you don't know. So then they're always looking at their time and saying, do I want to spend the time with these people? How serious are they? Can I make money? Because for them, they look as who's the best bet for them to make money. And so, but if you can speak the language, then you've got to when they send you a deal, which may not be a very good deal, as we knew when we started off, we got the bad deals. You give them feedback regardless, and you got to explain what it is you like about it, what you don't like, and why it doesn't suit you. And then you can offer, if you want, to put an LOI in, knowing that it's not going to be the right LOI, but you can offer, because sometimes brokers need help by showing numbers of offers presented for their stats. But I'll tell you, and you know this, Sanjay, that as you spend more time and you do this, you start building that rapport. You're talking to them a lot. The next level, though, the second level is when you actually say, hey, I'm coming to the market that you're looking at. And now you meet with them, you buy them lunch, and then you go tour some product. That differentiates you from the people just calling, because now you're there. You've face to face, you built the rapport, and they know you're serious because you're spending time in the market. You do that a few times, now you're up in the top, like the higher percentage now. And so now they're going to start giving you more opportunity, right, to look at
Yeah,
potentially a better
I
deal.
I know,
You're
like,
smiling, so you got a
it's
story.
no, it's not the story. I just like, I always tell this because I've been in sales for the longest time,
Yeah.
and there is nothing better than meeting a person, shaking hands with them, looking eye to eye.
Yeah.
That's a totally different feel that you get. So I'm a little bit concerned about the younger generation who does everything on text, right?
That's
Like
true.
they don't understand, like, you got to go meet with them. It makes a big difference. And so talking to them, as you said, finding that common ground, whether it is a car or whether it is travel or exercise, whichever it is, you obviously, but on for with me, it's all usually alcohol, something like that,
Yeah.
right? so,
Yeah.
so it's something that we do find the common, but there's nothing better than actually meeting somebody in person,
Yeah.
breaking bread with them, and having a good conversation. It doesn't necessarily have to be about business. It can be about family, friends, and a whole lot of other things. Then
Yes.
coming down to the business side of things, as you rightly said, at the end of the day, that person wants to know that are you a closer or are you not? Because all these things is good, but at the end of the day, you need to close on the deal. But giving him a good feedback as to why you don't see this as a good deal or why it is a good deal makes a big difference. So
Huge, absolutely huge. You know it, and the thing is that the more time you spend, honestly, I would say with most of the brokers, sure, we talk about business, but we do a lot more. It's like 80% personal, 20% business, quite honestly. But when it's time for the business, we're right into it. And I find the brokers that I've established myself quite well with, you can get them pretty well anytime. They're calling you, I'm calling them, following up. It's and so there's the third level, which is the what I call the final level, we'll call it, when you've actually closed on a deal in a market. Now they know you can actually do it. Now they really want to know you and talk to you, and you should let the other brokers know that you have closed on a deal if you're starting off. If you're in that market, they already know what you're doing. Most of the guys that we know, they know exactly where we're at, what we're working on, what we're doing, and which is good. And they'll just say, hey, did you close on that deal or not? And they like to keep tabs. And obviously, when you're doing this, you're very professional and you make it easy for them to work with you. And because that's huge for it. And then really after that, it comes down to now you've got a deal, let's just say, well, what are you going to do next, right? Well, you got to do the due diligence, and
Right.
there's some fun. So
Yeah.
so
So let's
there's
dive into that one.
yeah, due diligence, absolutely. So, due diligence basically, there's different parts of due diligence. There's the physical due diligence where you're actually looking at the property and you're trying to, like, generally, we've already been to the property once, but we haven't gone into huge detail, although we're pretty experienced. So, we pick up a lot with our eyes pretty quick. When we're looking at the roofs to siding or windows and different side like structural as a wood rot, all these things. And the HVACs is usually roofs and HVAC and parking lot. Those are the ones that don't pay you any more rent. So you're always very concerned about that. And then the condition of the units, we go in and tour a few. But when you do due diligence, you need to go and see everyone. And I'm always shocked when I hear certain groups and they say, "Yeah, no, but we didn't get into the last 10." Well, I guarantee you those are the worst 10. I guarantee it, right? Those are the ones, yeah, we can't find the keys. Sorry. Oh, no, yeah, no. Oh, there's a
Exactly.
dog in there or something, right? And meanwhile, there's no kitchen in there, no appliances, or who knows what's going on in there. Those are the ones you definitely want to see. And so, it still happens to us, right? I say,
Yeah.
no, every unit. And so we go back, or maybe not us, but our management company that's doing a lot of the heavy lifting for us goes back and because they'll say, well, we got them all except for a few. I said, great. So you're going back tomorrow? I said, yeah, you're going back tomorrow so you can look at those. Like every unit is what the definition, every unit, we look at them all. And when we're inside, I mean, we're looking at condition of the flooring. Do we have leaks from plumbing? Maybe there's something above us, or the roof itself's leaking. We're looking at the condition of the kitchen. How about the plumbing underneath the kitchen, the drainage? There's a carburetor. And then in the bathroom, I mean, do we have mold, mildew? What's going on there? Plus the condition of, like, depending on what type of tub it is, but what's the condition of that? Has it been recoated 20 times or is it new? Is there mold and mildew around the tiles or is it tubs around? Is there any leaks showing all that stuff? Electrical, right? We always want to see electrical panel because depending on the age, we personally avoid anything older than 80s because of cast iron, aluminum wiring, potential asbestos. I mean, all these problematic, maybe lead paint in some cases. We just don't want to deal with it, and they tend to have a lot of maintenance as these things get older. So we tend to try and stay in a certain range it's older, but it's not in my mind. And sorry, Sanjay, I'm getting older now. So my definition of what's getting old is changing as I get older. you know, when I was young in my 20s, they say, oh, that 20 years old, that's getting old. now, is put a couple more decades on that. And it's kind of like, yeah, well, 40 years, that's not so bad now. It's kind of crazy how that goes. Yeah, but
Yeah, you've ever had a challenge, Jim? Like I know a lot of people just say, yeah, send out the LOI. Then once the LOI gets accepted, yeah, send us the send the PSA. How complex is a PSA, and how many
yeah,
times have you got in the situation you have to go back and forth and not had it done until a very long time?
yeah, no, hey, that's a really good point. I did miss that point, but really good point because it does happen, and it's happened to us in recent times. So the whole idea is when you're submitting an offer, you do a letter of intent. So there's really no teeth to it. It's just showing your expression of interest and how you might like to buy it. And so typically in that LOI, you're going to have your purchase price and kind of how much time you think you're going to need. So that could break down as to how much due diligence, how much time if you're going to get regular financing or some other financing, may have a financing contingency in there and an inspection contingency. And so you shape some of those, and you may have certain requirements on income level or occupancy, depending on the situation. And then you have your due diligence list. So the whole idea is when they sign it, then that's when now you say you hand it off to the lawyers, right? And sometimes that goes well, sometimes it doesn't. So there's times where the two lawyers can seem to find the common ground, or, Sanjay, I can think of one project that starts with a W where it took us 7 months, 6, 7 months anyway, to get
Oh
the
yeah,
6 months anyway for the PSA purchase sale agreement to actually be agreed. And
yeah,
as you know, I ended up getting on the call a few times with the seller and the brokers to try and break through where you've got a couple of business people now trying to solve it as opposed to the legal people. And the legal people are doing what they're supposed to do. They're supposed to protect you. But sometimes if you get too protected, you can't get a deal done because each side's trying to protect each other. So it's happened. And then there's other times where, like you think of the one starts with an A that we closed on a year
yeah,
ago. It was fast because we'd already transacted with the seller, so we already had a basis of a purchase and sale agreement. We just had to update it for that property. So we literally had a purchase and sale signed, I think, in less than 3 days. And that particular deal we closed in under 3 months. It was 2.5 months or whatever it was. It was fast, that deal. Versus the other one kind of went to the moon and back. It took forever. It seemed that it was never going to go. I think that was 10 months, probably, that 9 or 10 months it took to do that deal. So it just depends on circumstances. But when you're in that whole contract negotiating, your lawyer's representing you, and you got to make sure you've got a good lawyer to represent you and protect you in terms of making sure that there's like if you're buying, that you're not exposed to a whole bunch of liabilities that weren't disclosed. And if they're not disclosed, what's the remedy behind it to help you get through it? Now, that's part of the due diligence, though, to make sure that you're checking these things, because once you've done the due diligence, you're kind of signing off that they have what's called reps and warranties. So they're signing off saying you've had an opportunity, and because of that opportunity, you should now know where you're at. And we always like to make sure we've got some language to protect ourselves, because if it was hidden from us, that's a different story. But once we've got that PSA, it's full bore to that inspection. You got the lease audit, right? Then you're into the well, that lease audit nowadays is digital, which is great. So they don't really need to be at the office. The old days when they had all the paper files,
yeah.
you'd get a small army of people coming in and they'd be going through all these files, and basically they're trying to match up what they see on the application and the lease itself, making sure it all matches to what the rent roll is saying. And so there's some semblance. So the date of move in to the expiry date, the rent, the terms basically, and the qualifications of the people. How did they qualify them? Those are pretty important things, because that rent roll becomes a critical piece to determine your revenue stream and the soundness of your tenants. Because we typically at Sanjay, as you know, at our properties, we're 2.5 to 3x income, no criminal background, no delinquency, paid. Like if they've not paid another landlord, then chances are they're not going to pay us either. So those are the things, some of the high level things we're looking for: no criminal background, all this sort of thing. So with that, if we're finding, when we're buying something, we're finding all these things out to be true, we have to make a conscious decision. Is this the right property? Is this within our underwriting? Because if it's not within our underwriting, to do more of a reposition of all the tenant base or a percentage of the tenant base, then we've got to decide, do we need to talk about this with the seller, because maybe it wasn't disclosed the way we thought it was going to be. Because, Sanjay, when we're buying, what do we get, right? What do we get? We get a rent roll, right? T12,
The T-top,
an operating agreement. Usually, if it's a broker, you get an operating agreement, or OM, not an operating agreement, but a operate or a
memorandum.
memorandum. Yeah, just basically where it shows the whole property, and it's a sales pitch. So please don't think that it's you
Sure.
got a buyer beware sort of thing. But they've got the details in there, and that's kind of what you start to clarify and check out. But it's got that. It's got a market comparison, right? And you're going to look at some other third-party data, whether it's CoStar, Yardi, to see where the rents are and things like that. And that then forms how you are going to offer on it and decide what you're going to buy or what you can afford to buy based on how you see it's going to run forward in terms of your ability to generate the income. For us, as you know, we are value adds. So we need to
Mhm.
push value of the property up in order to pay our investors. And that becomes
Absolutely.
critical.
No, that's the key. But there is so much that happens during the acquisition time, right? You have the PSA that has been taken care of, where the legal people are doing it. Now while you're doing the due diligence thing, you're also working with the SEC attorneys. You're working with the lender brokers and so on. So what does that look like? Because it's all fun, right? Because people
Well,
think it's so easy.
Sanjay, you're a very busy guy because I'm off holidaying while you do all the work. Okay, no, so this is actually a team sport. I joke about it because it's a team sport. You just hit on a whole bunch of areas, right? There's a lot of moving parts, and I like to use an analogy. It's like a baseball team, right? If you have a baseball team going, you can actually get a lot done when you're any team for that matter. But I'll just continue with the baseball analogy. When we go up to the baseball bat, like to get up to hit, we all want to hit a home run, right? So that's the ultimate goal. The reality is that we're probably not, and unless we're one of the top players that high percentage. But what's the primary goal then? It's to get on base, and it's to and so base would be to get a deal done, closed, and then it's your team that allows you through their expertise and us managing it to move it around the bases over time to turn it into a home or like a run that counts. And so when we are doing all those different parts, I just want to point out when we buy it, generally the split is we've got um, usually we pay our investors in two tranches. There's the ongoing cash flow. So if we said that's 6% on average per year, and let's just say we're trying to double the money in 5 years, which typically is what our goal is. So now we've got 30%, right? That's coming there, and that leaves us 70%. Well, that's the team trying to help us get around the bases, right? And make this a home run. And so that 70% becomes very critical. And we can talk more detail to that, but that whole analogy allows you to get a sense of there's a lot of moving parts. So when you start talking about how do you handle all these things when now you're under contract, well, there's usually as a team we start to divide and conquer, right? So we'll have one person being more primarily on the financing aspects. So now they're working with the underwriting and we use a loan broker, and we usually use a loan broker that's a direct direct to lender. And so that means that they deal directly with a Freddie or a Fannie, so we can skip having like some brokers, and nothing wrong with it. They don't have that option, and so then they have to deal with another company that has the ability to deal direct. So there's an extra step in there. What it does is when you do it the other way, the first way I said, it allows you to know they're talking directly to the lender, their team. Their team has direct, and they can do more of the process. So when they submit, they're able to do a lot more of the pre-work, and then they're Freddie or Fannie are doing the final parts to it. So, I mean, that's a lot of moving parts. And as you know, I've been busy working because we're working to close two deals right now, and we're still dealing with a lot of moving parts on those two deals with the lender and the lawyers because there's a lot of legal parts. So you've got the financing, then we've got the actual transactional work that's going on, which means getting all the documentation put together to actually paper this thing. And depends what there is in terms of what type of property you're buying, but there's a lot of different documents that have to be covered off on that. And then because we syndicate, we have a securities attorney involved. And so that security attorney is now drafted documents, and we have to look at the documents. We have to know what structure we're going to use in terms of how what classes of shares we may be offering, to how are we going to manage it, all these different things that come into play. Are you going to have one entity and doing both of that, or are you going to have a manager entity over here plus the entity that's going to buy it, and then you're going to have your ownership, and then you're going to have the general partners such as ourselves that are running it,
Yeah.
because typically we're structuring it a limited partner where they get the benefits and they don't lose any sleep, and we run it for them, and makes it a lot more attractive for them. They can continue on with their busy career and focus on that. So you need ideally team. It's very hard to do it all yourself because that's another aspect. In the meantime, the property itself, right? You've gone to inspect it. Well, now you've got to finish up with all that data. What about the rent roll? Is there any issues? What about the lease audit? And what about the physical due diligence of the property where you've gone and inspected every unit? And now what do you do with all that data? Is it good? Is it bad? You know, are you going to analyze like how many refrigerators you think and appliances you're going to have to replace? How many of the floors may have to go? And what about the HVAC units? How many of those are a potential risk? And compared to what you underwrote it to. And so you're
Correct.
trying to marry the two together to see, are we still okay? And that part is during what we call the due diligence period. So typically when you structure your deal, you've got 30 days. Sometimes it's 21 if there's a lot of pressure. When the market was really hot, they were wanting you to basically go hard money day one, meaning that you would just give them money for the opportunity for the deal and then take your chances. Before I got to that stage, they would say, we want hard money, but then you could get access agreement during the purchase and sale agreement time period, which you could drag out for 5 days, and you'd have your whole team focus on it, and you try and do due diligence in 5 days to get it all done. But essentially now we're doing that comparison to see, does it work? And if it's not working, well, because we're still within the 30-day D, we can choose to walk. And so we've still got some costs with the inspection, but we haven't put any money at risk because typically after the 30 days, you've got what's called an earnest deposit money that you put down. That would then go hard, meaning that it's non-refundable. It's part of the deal, and that's part of the idea that now you're committed, and that shows your commitment. And typically, Sanjay, as you know, for us, we do 1% of that. So if it was $10 million, that's $100,000 you've now committed to that, it's bye-bye if you don't perform. So, yeah, unless you have a finance contingency, which sometimes you can have depending on the market cycle, then that might extend beyond that initial due diligence period, and then it would go hard. Yeah. So I think as you've been part of it, there's a lot of moving parts. So there's various people that we try and make the lead, but we all can wear the hats and help out. Like we're flexible, right? So in other words, if our area slows down, then we can help in a different area. And then there's usually one maestro trying to make sure it all keeps going. Call it the head coach. So
So you talked about the baseball team. You talked about how everybody comes into it. So I know you're a sponsor and sponsor a lot of people who come in. You also have your own deals, but you also have new students who come to you asking you to be a sponsor. What is it that you look for when it comes down to your partners or the people who are going to be part of that league, who will be playing the game?
sure. Yeah, well, there's, a lot of it comes down to attitude. Obviously, you're curious. You always want to know their background because if someone's got a finance background, um, and they're looking to raise capital, you might say, well, you're more an analytical. Are you an introvert, extrovert? But so you try and look at it that way. But you look at the people themselves. But I look at the primary characteristics: self-starter, conscientious, basically um, like that self-starterness is huge because you don't want to have to direct your literally, this is like you're an entrepreneur, right? You've got to be able to figure it out and be motivated on your side. So highly motivated, um, good morals and ethics. So they want to do the right thing right off the bat. Um, for me, being strong family person is really aligns well with me because my family's here and business is important, but it's here, and those two shall never. The if it's a decision between business and family, family is it, and it's come up many times, and it is just too bad. The business will survive, but we've got to, got to make sure family, because you get one shot at that. And then just their whole attitude around life itself. So I find that if you have commonality with the people and you're getting along, and then they have those core values and attitudes, it sure makes a big difference. You can teach a lot to a person who is open to learning and willing to listen. I mean, what's the saying? 2 ears, one mouth. Listen twice as much as you talk. And if people want to think they know more than you or think they talk too much and they're not willing to learn, that's not going to be a good fit for us. It's different if you're really experienced, but I think being a really good listener, active listener, makes a big difference. So those I think are key points. And then that drive, if they're able to be laser focused and have drive, then we match that way. Because I don't want to be trying to motivate someone. I need them to be self motivated, and then the mindset that they're able to focus and regenerate themselves and push themselves forward. If they've got that, then it's going to be a good fit, no question about it.
So that's good to know, right? Because there are a lot of people who uh, feel that, okay, hey, how did this partnership happen? What are the key things that people look for, right? So those are some of the
Well, an
elements
Uber
that
driver in your case.
see, that's a big value add right there. So everything depends on how you look at it. And I'm a good Uber driver because I listen too. I
Yes,
ask
you
you a
do.
question and I just
Yeah,
listen.
yeah, I've noticed
So
that.
yeah,
I've
so that's
noticed you're just picking my brain as we drive, which that's fine.
no, that's the biggest learning thing for me is like that's the wonderful part about US, as I've noticed, right? There are so many um, sponsors out there, but when it comes down to you have certain great qualities about you. Is like you're a giver. You don't hesitate to share things. You'll talk about it. You are a good partner. You treat the other person as a partner, not someone who's just getting started or something. You do treat them like that, and you have a lot of patience. You do correct. But yeah, there are times when I've seen that you had some partners who try to uh, try your patience a little bit from time to time. So, but that's yeah. So there's a lot that I see that what makes you such a great person in itself. Like not only your experience, not only are you can manage things on your own, but you do bring in a good team of people and help them grow as well. So that's something that I always admired about you. So now that we understood the kind of team that is going to come in, what are the challenges that you see when sometimes the lenders take a longer time to close on something, right? Um, what happens over there? Why is it so difficult? Because it's very hard for some people to understand. So, well, all the papers are here. Why is it so difficult? Like they don't understand that there are times when you would have done an underwriting, you have started off with the process, you're raising the capital side of things, but then still underwriting still continues happening. There are changes that keep happening. There is an underwriting that happens during the process, and then after the close, there is another one as well. So
Yeah, no, it's a really good point. I just one other point just on I, as you know, believe in giving back. I had someone help me and that helped pull me up. They pulled me up and helped with my success and my wife's success. And I believe in the same philosophy. If we pay it forward or we all help each other pull each other up, it becomes a much better place. And so if I can do that to help others, then I get a lot of satisfaction out of that side of it. Obviously, the partnership and the byproduct of money, that's a byproduct. Ultimately, that's, I guess, the scorecard at the end of it all. But really, it's about helping people, and it's just kind of like why I was at the conference. And I'm going to deviate one more second from your question, which is, I remember when we first met in person the first time, because there was COVID that happened, right? So we've been on Zoom, but we never actually met in person. And that was in Dallas in September of 2021. So 4 years ago, we finally met because things had opened up and there was conferences, and we were at RE Mentors Ultimate Partnering, UP is for short. And when I remember us being in the bar area the Saturday night, having dinner with, I don't know, it must have been 20, 25 of us in this big, long oval. And you were sitting to my right, and we had a couple other people across from us, and Matt to my left. And so it was great. And we spent probably 3+ hours, maybe even 3.5, 4 hours together talking. And that was the first time we'd ever been able to talk in person. And then I invited you to come look at a property the very next day, yourself and Sunil, and which was one we were bidding on in Dallas, Arlington specifically. And it kind of formed from there even further, sort of thing. So the reason why I bring it up is because I just got back from that same event this past weekend. I know you couldn't make it this year, but ironically, it was in the exact same hotel. So when I went into that area, that flooded back that whole memory of how that all happened, which is pretty cool. It's pretty cool. So yeah, so that's that. So now let's have you maybe restate it, and let's go back into the other area because I've deviated a bit.
Oh, no, 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 it's okay because it does talk a lot about networking, right? Because that's a key part of our business as well. Like I remember, as you mentioned, I met you for the first time when they had this with Ari Mentor had this sponsorship program, and you were on there, and I just texted you right up because you came in. I saw you, and then I texted you saying, "Hey Jim, this is Sanjay. We had just spoken. Just we were there on this Zoom room, and can we get on a call?" And then you called me. You said, "Sanjay, when is a good? You give me a time," and we got in touch. And then you were the one who said, "Sanjay, are you coming to the UP?" I'm like, "I don't know." You're like, "Sanjay, you should come." And that pretty much I said, "Okay, I think I should come." And that's where we met. And networking was such a key part. That's where you get to really know each other much better. So I think I hope you had a very fruitful UP this time, and
Oh yeah, it's honestly, I've been going 10 years now, so it's like going home more or less. You've got a lot of people there that I've known that whole entire time that I've met there, and it's pretty cool. And seeing their kids there too, which I've known as well for that, and now they're married and they've got their own children. It's pretty neat to see, and so yeah, I really enjoy that aspect and the networking of meeting a whole bunch of new people. And then also they were very kind to give me opportunity to speak, to try and give back with some knowledge. I was very grateful for that opportunity. And then they also had me up on another stage with a small panel. And so you're just trying to give back. I wasn't there to pitch anything or sell anything. I just wanted to try and help people. And so hopefully they got a few gold nuggets out of it, which hopefully I feel they probably did, but it's always, you have to ask them. but it was really good. And that's part of that whole giving back, helping contribute to other people to help them move forward. So yeah.
awesome. So now we'll come back to the lender side of things, and
Yeah.
what causes the delays, why things happen, so on.
I still have a full head of hair. It's pretty amazing. It must grow in pretty fast because there are times where you want to rip your hair out with those guys. There's a process, and you can't really influence it other than well prepared, and you make sure everything's thorough. And if you have a great conduit, I'll call it the broker and their team to help package it all together. So between our team and their team, and so we have that, and we put it all together, then it goes into the next stage, which is outside of our control. All we can do is be ready to answer the questions. But there are times where we think we've answered every single question we could think of. And we've got a lot of experience at this because we're a preferred lender. We've done it a long time, but they still come up with different things every so often. But we're really quick to jump on it. But sometimes, like right now, current day, they're just really busy. And this is typically at this time of year when they get really busy with deals. Now they're trying to get closed by a certain time, whether it's now to Thanksgiving. Then then there's the rush to get it done before the end of the year. But now you're dealing with both Thanksgiving and Christmas, and there's a lot of days off, and it gets really hard. And essentially, the cutoff, I actually forgot to ask, but I got to think the cutoff is very close, if not already passed, to get a deal done with the agency guys now, because we are sitting here pretty well almost the beginning of October as we record this right now. But I will say that it's we try and do everything we can, but when it does happen, you've got to make sure you got flexibility in your contract, and that's why we put extensions in ours. And I know sometimes people grumble about it, but there was a situation yesterday where I had a student call me from this past weekend at UP asking for the advice. They're saying in this contract, the broker's pushing back. They only want to have the due diligence of 30 days and the 30 days to close. And they said they would maybe give us an option for 30 more days, one option, but they wanted a whole bunch of money and it would have to go hard and all that fun stuff.
Yeah.
And I remember saying to this person who's named Mary, I said, Mary, you can't even get like, are you doing agency? Yes. I said, you won't even get the agency done in 60 days. So you need to have a 60-day with a 30-day
Extension.
or two 15s at least, so you can exercise one and exercise the next one. And it's those sort of things that get you in trouble. Then the seller has you, and granted, if the seller is highly motivated because of problems, then they're probably just going to be happy to get it done and allow it. But when things are going well in an up market, the seller has it. Well, they can exploit the situation because if you need an extension and you don't have it, they can charge you more money. And you're at their mercy because now you're in because you've got what's called the earnest money, the down payment money. You've got a certain percentage of that up. You've got all your costs, right? Because we've now put the money up for the loan. So there's an application fee, there's the appraisal, the third parties they're called. So you're going to have a environmental phase 3 and so on and so forth. You've got background checks you're going to do, your lawyer's going to do. So there's legal costs mounting as well because that person's working on the contract and everything. So you got all these costs that are going to be there whether you close or not. And so you go, well, we don't want to not close. So you've got to structure your deal right. And if they won't agree to it, then you need to walk away from that. You can't afford to be in that. That's gambling at that point because you just know. And there's different times. There was time when agency could do it in 45 days, but that was optimal. And there wasn't the same amount of volume. But right now, there's a lot more agency deals being done, and bridge is starting to come back. But when it was reversed, when we had that really hot time I talked about where it was better to do bridge than agency, well, at that time they didn't have the same volume, so they could process it because they weren't that busy. And the bridge guys were struggling to get it done, which are typically 30 to 45 days. They were pushing the 45-day window, sometimes even up to 60. So you've got to make sure you've got the right structure. And so what can we do? We can make sure we've got everything as organized as possible with the information. Our underwriting's accurate, applications are filled out. You're going to need what's called an REO. If you're on the loan, So typically, let's just say if it's a $10 million loan, I'll just use that number, then they're going to be looking for at least $10 million worth of net worth from the key principals, the key people signing on the loan. So if you don't have it, maybe you and another person has it, or a group of you have it. Well, then you're all playing on the loan together. And if it's 20 million, then you're going to have that. At some point, it does stop though, where it's one for one as you get into bigger dollars, where then they start dropping that ratio down because, at 50, $60 million for you to have 50, $60 million net worth and 10% liquidity, like $5, $6 million, that's a lot of liquidity on a loan. But typically, as you're in the, say, 25 million and less, maybe a little bit higher than that, you're one for one. So in other words, you need liquidity on $10 million of at least $1 million liquid. So it could be in stocks, cash, but it can't be in a retirement savings plan. It can't be your house. It's got to be liquid funds. And so that's a key component of a loan within your team, that you've got to be able to have that in order to qualify. And so you do what's called an REO, and that shows what assets you own for real estate, and it helps start to talk to your experience. Usually at the beginning, you'll need a resume to go with it. As you've done more loans, they just know you because you're already on their record, and they've got transactional volume with you, so they can see how you're performing. And then, there's a lot of forms, but as you fill them out, you tend to get good at them. Or in our case, our team, the lender, we're doing enough of them. They just fill them out for me. I love them for that. I don't touch them. They just send it. Hey, Jim, check it over and sign it. It's just wonderful. I love it, love it, love it. And so there's that aspect. And then you need a net worth statement, right? That you attach. So you got your real estate owned and your net worth, and that goes in. And for each of the team members that's going to be involved in the loan, they have to do that. The lawyer is going to be required. Usually, it's our transactional lawyer does it on their behalf. They do background checks, so they're going to check for criminal, credit. They check everything for you, and you're also disclosing, do you have any criminal record or bad debt? Do you have any guarantees out there? There's recourse and non-recourse. So in our world, we like to do non-recourse loans. So as long as we stay within the rules, it's non-recourse. If we're bad people, then and we break the rules, which they've got laid out what that would be defined as, then it becomes recourse. You're on the hook for it. If we never go into the bad area, we stay in the good area, which most people obviously would. And so it's recourse. So what recourse means is that if it was to fail, then we would not be personally liable for it. However, I will say if it did fail and we gave it back to them or something happened, we're pretty well done because now you've got that on your track record. Recourse means that you personally guarantee the amount. And so depending how you've got a structure, you've got partners, you may have it prorated as to who has what, or it could be, it's just wide open and whoever the lender can get the money from, which unfortunately we've seen, right, with some people we know, they weren't smart enough to structure that. And so it means that you're liable no matter what happens. So if the property can't pay the loan for some reason, then you've got to make up the shortfall. And so anyway, from the lending aspect, there's only so much you can do, and it's your team at the lending side that pushes the lender, depending what it is. But there's also CMBS, which could be insurance, and other people that will lend financial institutions compared to the Freddie and Fannie that are federal agencies. So there's different options out there. There's credit unions as well you could potentially borrow from. And so there's a lot of different financing options depending what type of product and what fits your needs.
And how often have you seen people make this mistake of going with the wrong lender?
Well, I guess within our communities that we belong to, because we mentioned Prairie Mentor, but we belong to several of them. So we get to see the various networks, people, and so we get to know quite a few people. We'll say for those that are maybe not as experienced, it's more common than you think, unfortunately, because they don't know what they don't know. Hopefully, they've got someone to help guide them with experience that they could, a mentor or someone to phone and say, "What do you think of this?" And they can help put them back on the right track. But unfortunately, it's happening. And or the broker feels a certain should go a certain way, and unfortunately, they don't know that it's maybe not the right way. It all comes down to, like, when we underwrite, we have a certain strategy, and so typically, how long do we want to own it for? And
Right.
what's our plan to improve it or to unlock the opportunity? And that quite often ties back to the financing. So, like, specifically, we see a lot of people, when they lock a loan in, they'll go 7 or 10 year term, right? But they want to sell it in
Yeah.
5. So, okay. So they were just all about the lowest interest rate, right? And they wanted the potentially largest interest only period. So they don't have to pay a payment and interest at the same time. We do it completely different. We say, okay, what's our plan? Do we want to refinance in 3 years, 4 years, 5 years, or do we want flexibility for a certain period of time? Or in this particular environment, I've been on all the loans saying it should come down at some point, this interest cost. And so
Right.
we wanted the flexibility. When it was the other way, when it was super low, yeah, we were taking 10-year loans. We're going to keep this and go as long because it's an asset. Because if interest
Correct.
rates go up and you've got a loan at 3.5% or 3%, and now it's 5 or 6%, well, that improves the cash flow. That's worth money. That actually helps improve your property. So you can actually allow people to assume those, and then if it's too low as a percentage of the purchase price and they can get more room, you can usually put what's called a supplemental on and blend the interest rate together. um, so when in this market where interest rates are high, but you're thinking it's going to go down, I'm not doing what some people are doing, which is locking in long term. We go with a step down, which means that it allows for the amount of money you would owe. So on the first example, if it's 10 years, you need what's called a defeasance calculator. And if you're saying, okay, we're going to sell it in 5 years, well, how much lost interest income is that for the investor that put the money up for that? And basically, there's a calculation based on today's rate. So the current value versus that future value, and they calculate that out as to what the defeasance shortfall is, and that's how much it's going to cost you to get out of that loan. And it can be significant dollars if there's more time, because it's the time factor that goes into it too. That is crazy because that can wipe out your profits. And a lot of people don't think about it. So now when they go to sell, they're going, uh-oh, we're not going to make any money. Versus we've got a step down where usually ours is a 3% defeasance fee. So 3% of the amount of the loan in the first year, 2% the next year. So it's 2% of whatever the loan balance is. And then the third year on, it's 1% of the loan balance until, if it's a 5 year, at year 4.5, it's zero because the last 6 months, and it'd be the same on the long-term loans. At the 6 month mark, they say, well, it's zero because you got to refinance. So that's a strategy
Absolutely.
we do compared to others. And so we see that a lot right now happening. And so when we go to the market and these people say, yeah, no, it's assumable loan and it's going to be at 6%. And we say, okay, how long is the loan? And we say, what? There's 7 years left? Oh boy. So now we're discounting because do we want that loan? They're hoping you take it over so they don't have the defeasance fee, but no thanks, sort of thing. We're saying no, we want our structure in, so we'll put our own loan on it. But we had a deal that we closed June 20th, 2024.
Yep.
We took over the financing.
Correct.
Financing was 4.31 or 4.41, and we had just over 2 years. Well, it was perfect because it allowed us, it was high enough leverage. It allowed us to fix up everything and unlock the value. And so come this May, we've got to have it fully done, but our income is up substantially. So it affords us options now. And I don't know if interest rates would be where that is, but still, we were able to do it short term and now potentially revalue the property and recapitalize it, depending what we want. We can put that capital, the capital that's employed, we can choose to pay back the investor some of their initial investment. If some of the people say, hey, we want out now early, hey, we could do that. I mean, there's different options. Or we can just renew it at the same amount of the loan balance. And because in this particular case, we've got the capex really well underhand, we don't really need any extra reserves, and enjoy cash flow and do the step down. So, we find at some point here we need to refinance it, maybe lower interest rates, it's worth it. And then we can ask the investors the same question again. And so it's about flexibility. Yeah.
So coming down to now the investors itself, right? I think sometimes I feel that we have spoiled our investors to the point where we've been giving them a specific 2xing their money and a certain cash on cash. And as you mentioned, there was a barrel which you could just pull out any fish, and every fish was a great fish, and so on. So everybody was really having a great time, wonderful time. From an investor expectation, what do you think has to be changed? Like, where do you think the investors should really be happy about? Because everybody is promising the same thing to them, and they're all looking at it as, oh, but yeah, this guy is telling me that he can 2x my money versus or 2.5x my money, and so on. But what is the reality that they should be really more focused on? Is it more real like, hey, let me bet on the operator, right? Because it's the operator who can make or break the deal. That is the key to the main thing. Because one of the things that I have learned in this business is that one part of it is buying the business, like acquiring that asset, and then the second part is managing the asset. So it doesn't matter how good of a deal it would have been going in, how you manage it can make or break that deal completely. So,
I agree. Yeah, I agree. Well, from an investor standpoint, we see a lot of different decks out there in terms of, and so we're a small boutique operator, and we very personalized service. I mean, that's our differentiator compared to a REIT, and the whole thing is that we're doing the heavy lifting. Like, sure, other people can invest and buy multifamily, no question about it, but generally with our expertise, the thought is that we can outperform the average person by far, and they have freedom to still enjoy probably a better rate than what they would have got. So I mean, those are the things. But as an investor, when they're reading some of these other pitch decks, they go, wow, I can get like, so we're at our level, which I still think is very, very generous, quite honestly, maybe too generous. And then they see these other people saying they're going to give more cash flow and a bigger back end, but do they? And that's usually where you've got to do the homework, because we have found, we don't know firsthand, but we've heard, and we're not trying to spread rumors, so no names being mentioned, but we certainly have heard quite a few groups tell you what you want to hear, but can't deliver what they want to hear. And I think that's a differentiator. And people have to judge us for who we are. And I'm not going to say much about that other than to say that we pride ourselves on a lot of stuff, and we've been around a long time, so it helps on that side. So expectation of the investor, if they are talking to the people and they get a good feeling and they feel, especially if they know other people that have been involved and they're seeing what's happening, it sure helps a long ways. And I tell you, every property's got its own personality, right? So you can be the best operator in the world, but there can be different things happening in a different market that happen, such as lately it's been all these new builds coming on. And so it's saturating the market. And with a saturated market, you've got to pick up all that extra inventory. Well, it can affect all the way down the food chain in terms of the different classes of properties. And we're experiencing it on a couple of ours right now. Or you can have a situation where someone lost the property and is going through foreclosure or has gone through foreclosure, and now the bank has sold it, and you've got a new owner in there that's aggressive, wanting to lease it up and doesn't care about revenue for the first little while and disrupts the market. And that disruptor can wreak havoc on the property in the short term. And so you've really got to be steady. And if you've got a great community and that community believes in it, they're not going to hear all that noise and leave. But there's still a certain percentage that do turn over anyway, and those then become harder to fill up. But from an investor standpoint, if you believe what you're hearing and you feel there's credibility of what they're saying and you know what to ask, and that's why a lot of people go to these groups. They maybe want to buy, but then they learn maybe it's not for them, but they've got the education now. They know how to read a financial statement. They know how it's structured. So they have some knowledge to ask the right questions. And then, of course, there's the professionals that are accountants, whatnot. They know how to read financial statements, or other professionals that are just intuitively very smart, and they know how to drill in and dissect these things, which I think is wonderful. So for us, you also asked like what the expectations and where that's at, and yeah, and as the interest rates lower, I really think the cash on cash has to come down, because it's very hard to obtain that cash on cash level. But we were somewhat forced into it because interest rates were higher. So you could get a certain amount on a GIC or in a bank account that was locked in, or the Fed money, like a Fed rate. And so you've got to make it attractive above that. But certainly when interest rates were down at virtually zero, I mean, then if you're giving 4 or 5%, it's really good, because and so you can be lower. And I think overall rate of returns, it is ambitious if you're trying to double your money in 5 years. I mean, that's pretty spectacular, quite honestly, if you can achieve it. So I think a lot of cases we might need to really revisit that expectation. We've achieved it quite often, and so now it's an expectation, right? So you're kind of done by that. But it's I think the investors will understand overall, because at the end of the day, here's what I know, Sanjay, is I've had success with properties, especially when I talked about that 2010 to 2018 period where it was just like crazy. And if you're a skilled operator, like if you're unskilled, you'd still do pretty well. But when you're skilled, you'd crush it, because you could just open it up and turn this into a lot of money. And that's we had good success at that. And so with that came an expectation at a certain level, and that was unprecedented. And now that became the new norm. And we had to say, well, hang on, hang on. But really, at the end of the day, we need to back all of that off a bit, because what I found is we gave people their money back and they said, oh, that's great. Well, what's the next thing they said? Here you go. We don't want it. Invest it, please, because they like the cash flow. And
Correct.
so that's why we've rechanged our philosophy, which a lot of people are. We're more long-term holders now, but we always give people an opportunity to get out. And me being older too, I want cash flow too. It's a lot of work to find a property and to make it work great. And if it's working great in a great location, let's just keep it. Let's enjoy
Yeah.
it. I think we've changed our view on it compared to when you're starting off and you want a track record. And granted, if they're in the wrong location and it's more of just, hey, we can make some money for everyone, fair enough. That's not going to be
Yeah.
in the long term, but we're definitely looking long term now. So hopefully the investors are happy to come along with that sort of ride, our philosophy, and but we still give them an opportunity to get out. And
Yeah.
I call it, I feel like our investors are an extended family, same way as our tenants. Our tenants are an
Correct.
extended family too. I just really, really feel blessed for them to choose us as a community, but also that we have an obligation, I think, to make it a great place for them to live. By making a great place to live, it really brings a lot of satisfaction.
No, it definitely does. Like it always feels good when we go there, and you see that big smile on their face that they're happy.
Yeah,
And when you make subtle changes like putting in a camera, trying to make them feel safe, right? So they feel good about it, and all that tenant appreciation thing that you do. People come in and say the crisp things that you did when last year in Texas as well as here in Georgia as well. People really like it. They do feel like they are appreciated as well. So those are good ways of giving back. That's one of the things that I do like about this business is it's not so much only about making money for our investors, but also building a community where they can raise their children in a very safe environment. And that's one of the greatest things that I feel, because I'm a firm believer that children that are raised in a safe community become better citizens. And that's something if we can bring to them, that's a great thing. So
I agree.
that all comes down to operations now. So let's focus a little bit on the operations side, if you think we are ready for that part of it, because that's a major part, as I always say.
That's a big subject. That's the
That's a very
five
big
years
subject.
worth of work usually that you're looking at to make the rate of return. And yeah, but sure, absolutely. I mean, that operational excellence is what makes or breaks it. And a lot of it is understanding what works. And so you need a lot of measures, KPIs or metrics to compare to. And we're
Well,
very good
because
at
a lot of
developing.
people think it is a very easy thing to do the operations, because a lot of them think, oh, you just hire a property management company and they'll take care of it, right? It's as simple as that,
Yeah, yeah.
which it is not.
There's
And then a lot of people also don't understand, oh, well, you did tell us that they were a great property management company, but why are you changing them now? So, you know,
Well, there's that, or other people that hire them say, "Well, they're terrible. Why do you think they're good?" And so
correct.
a lot of it comes down to how you interact with the property management group and how you help them be successful and help them understand. Now, the larger management groups have great analytics that are available. It's just a matter of do they use them or not, or how they use them. And we're big into looking at all of those things. So we want to measure a lot of different criteria so that we can give that feedback. And we spend Sunday prepping. Monday is a big day for property management calls where we're meeting with the different groups. And I'll just say the general cycle is when we first take it over, we're meeting every single week for the first year, maybe year and a half, depending on how much work there is to get it to our goals that we all have set and the capex. And so, but once that hits, then we're every second week. We have a lot of properties that are every second week, and I don't feel comfortable going beyond every second week. I like to keep tabs on it. And the other part of it is, Sanjay, as you know, because you're my Uber driver, every quarter I want to go see every property, right? And sometimes more if there's something else going on. But I like to keep one in having the interaction with the team there, but I also like to see how things are. And some cases it's great, some cases there's room for improvement. And so we give the feedback. Or if we're seeing that we're worried about community maybe slipping a bit, what else can we do with that? So I think like yeah, every quarter I like to go out, visit every property. And if it's really cold here, I may make an excuse to go see them again and just show up because it's always nice to get down south where it's a lot warmer. But getting into the operational stuff, when we first take over, a lot of it is welcoming the management team to our family. And, we're here to support them. We're here to help make them successful. And so, getting to know them, what's their super strength, where's their weakness, how do we protect that weakness, and really cultivating that. And is there a shortfall with training? And especially if they're new and they're coming into a management company that they haven't worked with, now they've got the learning curve of all of their software and their way of doing things, which is into itself can be quite a bit of very daunting. So we're there to help make it easy for them and facilitate, but we're also there to make sure our objectives are delivered. And so we have, goals that are very specific and metrics that are very specific, whether it be on delinquency, turnover, the occupancy, definitely turnover. Our goal is 35% turnover. And a lot of properties, national average for workforce housing is 50% and or more. And so if you're at 35%, that is one of the secrets to our success is by creating a great community and people love to live there. And, we obviously need to increase the rents, but we're not trying to increase them at a huge rate. We may renovate and get it to market. And then once people are in, we're just there to kind of keep it going, keeping cost of living and have a great community. But by doing that, we're able to obviously generate the income to keep the property fit and everything, but it also keeps our investors happy. So it's a win-win. But so also the other thing when you've got the turnover, like we're really watching as a GP group is the maintenance, because one of the number one frustrations for our extended family, the tenants that are living in there, is things don't get fixed, or they don't get fixed right the first time, and
Mhm.
or they take too long to get fixed, or they get partially fixed and then they never come back. Or we've had situations they've phoned it in and it's just forgotten about, and so none of that's acceptable with us. And so we really like to measure that, the speed at which simple repairs get done to more complex repairs. We have metrics around that. We really insist upon that. But our part is to make sure they have the money and the purchasing power to buy the right things at the right price for us. So we want to make sure it's priced well. So we're always analyzing the cost, and we know our costs incredibly well, and negotiating. I mean, typically large management companies have contracts and whatnot, but we negotiate beyond that as well to see where we can get it down to. And basically, it's literally for the maintenance people. We try and set them up on what's called a Kanban system, and that essentially is where they've got a set inventory, and there's a trigger point in there, and that trigger point says, let the manager know we need to order this part. And that then is because sometimes they order it and it's already pre-set up with the vendor. Okay, they know the X quantity to send to top it up. Filters for the HVAC units, the furnaces and whatnot. That's a Kanban item because we're always quarterly doing maintenance on it. So by having these things, we try and make it efficient for these guys, but we make sure we've got quality parts and they've got the right parts to fix it so that we're demanding they get these things turned around. But we have to make sure we don't want a lot of inventory, but we want to make sure that there's a short supply line, timeline for them to get it so that it can be very lean in what they're trying to achieve, and so we can get it turned in and put in. If it's a regular item that's used, we'll have a Kanban and we know what the efficiency is and we know what the cycle time is on it. If it's a more custom thing, then no, we're not going to have that. But we'll always have, for emergency purposes, a spare refrigerator, like several of those, especially depends on the size of property. If you've got a 250 unit, one refrigerator, that's suicide on a property that size. You want to have, because we want the customer service again. If their refrigerator is going down or we can't fix it right away, switch it out and then repair it and put it back after the fact, because we don't want to see them lose their food and whatnot. It's really being conscientious. I like it to they're our customers. I call them extended family, but they're the customers in the business world. And what can we do to be excellent to them? And from a management standpoint with our team, really it's about what can we do to help to make sure you can do things better? What roadblocks are you having? And that's one of the key factors that we talk about and just see where they're having trouble. And generally, once we've cleared that up, then it's about, okay, what about this? How do we improve this and that side of it? And so there's a lot of different areas, and it's hard to get into all the different areas here, but
Absolutely.
maintenance is definitely one of the biggest areas. Collection of rents, making sure it's consistent. We believe that we've offered a great place to live. You've got to pay us. And we know people get in trouble, but we still file on the people after, and we say it's nothing personal, it's a business. If you can figure it out, we're here for you. We can cancel it all, but we've got to make sure we protect the business and the rest of us by making sure we get paid so that we can keep everything going. So we will file on you, but in fairness, if you can pay by such and such a time, we're good, sort of thing. And so it happens every so often, and sometimes more so, depending on the time of year. And, as you get into Christmas, people have a tough decision. A lot of these folks, do they buy Christmas presents or have the money for the rent? So we understand, and we try and help out. You mentioned about giving back. A big thing is, of course, the kids going to school. It's expensive time for the parents when they're going back because chances are they need the supplies for the schools, and probably some of them are going to, because they're growing, they need new shoes
Yeah.
and new clothes to go with it. It's tough. So, we try and help out in a small way by making sure we buy all the school supplies for all the kids at our properties. And it's a small thing to do, but it gives me a lot of satisfaction helping them. But I love that they've got what we call not expensive, but really cool backpacks that they feel great about. So we make sure they've got a whole bunch to choose from. Pencil crayons, like I remember my daughters when they were young. And so we try and make sure we buy the bigger packages with all the colors in it because chances are they wouldn't get it. Why not?
Mhm.
It's a nice little thing to spoil them with. The lunch kits as well. I mean, all these things, it's a small thing, but it means so much to the kids, and they feel good about
Absolutely.
it.
I think it's key that not only it helps giving back to the community, but it also is a key part of the tenant retention. And having tenant retention is, um, it definitely helps the bottom line a lot compared to if you have to do a lot of turns. So, you know,
Sure. I mean that, yeah. So for me, first and foremost, it's helping them,
yeah,
and the byproduct is that we're creating a great community. But I'm not doing it because I want to create a great community. I'm doing it because I want to help them, and so
correct.
that's just a byproduct of it. So I mean, it's great, but yeah. Um, to me, to be able to help them out and know that the kids got a big smile and they're proud to go into school and they got a great attitude around it, it's pretty cool. And yes, you're right. It certainly, the byproduct is it should help with the community, but that's not the first and foremost thing. We're trying to help families first and give back to them. But yeah, so same at Christmas time as well to help them. And so yeah, so it's pretty cool. But all these little things because we care. Like for instance, last Monday I was in a property and we put a dog park in recently, right? And so we had a couple of tenants come up, and I thought it was so cool to hear her talk about the dogs are off leash in there. They love it. At first they were kind of snarling because they didn't know, but now they all know each other, and so in the complex, we used to have them all barking at each other because who's that and what's going on. Now we don't have that because they're getting along because they kind of know each other. Who knew? But they love it, and so it's a social event. We also put the whole gazebo in there with a couple of picnic tables and outside the dog park on top of the other seating area, but with barbecues there so they can do things there. And so it's just those little things like that help. And so they're meeting their neighbors too as well. So you're building it that way. And I'm going back in uh, next week back into that same area, and we're having a tenant. So there's a conference I'm going to go to, but we're also on Saturday having a tenant, a community event. And so I'm going to stop in and say hello to people. And last year, Ricky was there as well, another one of our partners. And it's just nice to be out and Well, we were all out at another property, right, in the spring, and so we
Yeah,
go out to our properties, and we're not owners that hide. We're owners that are, I would say, proud of our properties, and so we're if there's something wrong, we want to know about it. We don't want to hide and have the management company deal. I mean, obviously, the management company is responsible for it, so we're not going to circumvent them, but we want to know, and so let's work with the management company to solve it. Let's make sure it's real, but solve it to make sure it's better place for them. So operationally, we're going through this month after month, right? And we're making sure that if there's a problem, we've got it solved and fixing things. Preventive maintenance is huge. We most of our properties, we have to get it up to a certain level first. And once we get it to where we want it, then it's about maintaining it through preventive maintenance. And it sure is a heck of a lot easier to do preventive maintenance on a cycle than it is to deal with the maintenance people love it because they have a lot less calls to deal with. And the tenants love
exactly.
it because they're not having to call and or being disrupted by things. There's
Right.
still be stuff that happens. I mean, it's inevitable, but we've reduced the amount of it. So by putting some of those things in place, it just helps overall from us managing it on a planned obsolescence and frequency to satisfaction. So we're
Now,
doing all that.
when you talk about Kanban, just in time preventive maintenance, it reminds about the manufacturing experience. So
Yep,
a lot of that was the one that all that experience was transferable. Is that how you kind of try to
sure.
optimize
Well,
this?
yeah, in my other side of my life, I had an opportunity to be an owner, a partner in manufacturing company, and I mean, that was a big part of, you know, I've been around long enough. When I started, it was called best practices. We didn't do Six Sigma and lean manufacturing at the beginning. It evolved into those names, but yeah, I mean, I'm a big believer in it. Of it, shadow boards being organized. When it was last Monday, the same property, I said, we got to get this maintenance shop fixed up, guys. I know you're busy right now, but this winter, when we slow down a bit, we want to see you get organized with the shadow boards and explaining it all. It just helps from an efficiency standpoint. And in manufacturing, these are techniques we use, and it helps us be competitive. And so, why not bring it into the multifamily world? A lot of people don't, but why
Right.
not bring that expertise in? And also, we bring that same sort of lean value stream into our processes with the management company and whatnot. When we look at a process to process a check, or we, for instance, we have this process with one management company where, in order to get an eviction check, they need someone to talk to them, and then they issue a check, and then that check has to be couriered to the property, and well, there's by the time you go through that whole value stream, you go, wow, how can we streamline that one? Because you think about the hours that, when you repeat this cycle, we can shorten that cycle, how much more efficient it is for everyone. So, I mean, those are things that, yeah, for sure we'll look at. And yeah, I mean, you've got the same manufacturing background experience.
Yeah.
You're in sales, but manufacturing as well. And I am as well. And so, yeah, in my world, I, had operational responsibility and was heavily involved, and even latter part setting up a couple of facilities with the help of others. I didn't do it on my own. It's a team thing. I'm not trying to take credit for others, but we did it together, and I was the boss of it all. But yeah, so I think it's pretty cool to bring stuff like that in and teach people those things because they don't know it. It's just not their world.
Exactly.
Yeah, but there's a lot of value with that, no question. So that's a
No,
differentiator.
no, those are the things like that I noticed when when we started working together and partnering on projects and so on. I was like, man, That's a lot of the things that we did when I was in manufacturing as well. So a lot of that streamlining, the process controls, and so on. So that definitely helps because a lot of people don't come from that background. They don't see that, and they think that asset management is a really tough thing, which it is. I'm not trying to take anything away from it, but it can be streamlined, and if you do it the right way, that's what is makes everything very effective. So. So now that we kind of covered, because I know operations is a very, very big subject, how do you
70%
kind
of
of
it, it's 70% of the
yeah,
money's made there. So yes,
but
it's huge.
now now it comes down to positioning it to sell. So what is the strategy behind that about positioning it to sell?
Is it positioning it like when you're initially looking at it to buy or positioning to sell? Sorry, you said positioning to sell. Yeah, I mean, there's a whole nother course on that, basically, because there can be a lot of strategy to that when you're trying to get it ready. You know, one of the things is when you're doing this, um, timing of the year comes into play. Even buying, quite honestly, it's the same rule. For instance, during Christmas or the holiday season, so you go through Thanksgiving into Christmas, that becomes a tougher time for collecting money. There's a higher potential of having delinquency through that time. And what that equates to is that if you're having occupancy dropping and or delinquency, it affects your net income, which then affects your that net income then translates to the value of the property. Depending what the cap rate is, you divide those two to come up with a dollar amount. And if it's dropping, but you're trying to maximize what you're getting, that's not the best time to sell. And it's also a terrible time or a tough time for a buyer to buy because if they're buying at a certain price, let's just say they've got it under contract in October and now they're going to close January as an argument, or maybe it's November and they're going to close January, February, but their income has dropped. Now their proceeds on their loan is going to go down, and they're going to say, "Whoa, that underwriting no longer works the same." Because the ratio of loan to capital employed starts to change. And so, with that said, we tend to try and sell in the best months when it's leased up and things are humming. And generally, during the best leasing period, our strategy is operationally to have more of those coming due because we've got a bigger rental pool and we can rent it for the top dollar rather than in the slow season when there's very few people and it's tough to rent. We tend to try and lease ours during that optimal. And the same strategy for selling is the same idea. So you've got the highest net operating income. But with that, you want to make sure the property looks good. And so it presents well. And just going back to manufacturing, if you were had people touring, if it was your customers, whatever, it was tour ready. Well, you're going to have a tour ready for a prospective seller, meaning that the landscaping looks great. Any units they're going to look at look great. Leasing office looks good. Maintenance shop, all these things. If you got a pool, you want it to be show ready. And then, like going back to the operational side, what is capex and what isn't? And so I'm going to say a lot of operators try to shovel, and I use the word shovel a lot down below the line as capex, and maybe it isn't. So you have to decide, is that legit? Expenses going down below, or are they trying to hide it? Sometimes they play the game of leasing up quickly if they have an occupancy issue, right? And they lease up with what we term heads on beds in our industry. So they maybe are, we're 2.5 to 3x, but maybe they're letting them in at 1.75, 2, and they've had credit issues and or not the greatest um, record of like maybe they have a criminal background. Like there's different strategies people use, but they let them in, and their hope is that they can get long enough. They'll pay long enough so that when you sell it, you inherit this, and chances are they're not going to last. They will start not keep their job or not pay, and now you've got to turn it over. And so when we see a rapid lease up from a buying side, we go, whoa, 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 let's analyze this because we're not thinking the tenant base is so stable, and we underwrite accordingly to that. On our properties, we make sure it is stable. And if there is delinquency, we show it. Like we're going to show what it is, but we're also going to make sure that anything that is capex is pushed down below line, and things that aren't, that are what we call repairs and maintenance, that are in the R&M category, are shown there. And so we want to make sure our books are as organized as possible. And when you buy a property, you have a whole due diligence list. So when you sell a property, you need to make sure you have that whole due diligence list. So we start collecting all the information, building it into a cloud virtual file to have it all ready. And so we're making sure it's optimized. We're deciding if there's major capex, do we do it or do we not do it? If it's less minor capex, we have to keep operating the property. We have to assume it may not sell, and so we keep operating as if it is. If it's a major capex item and it's not necessarily needed, we may choose not to put the money in, and then the next owner can choose if they want to do it now or later. That's up to them. It depends. If it's a life safety issue, no evans or buts is happening right away. We don't fool around with that stuff. But if it's some other item that's just cosmetic and it could look better, maybe it's doing repainting, but the paint's still pretty good, we're probably going to leave it because we're not going to spend any more money, because that's a personal choice at that point. But you've got to get it ready. You've got to have your files ready, and signage has got to look good. These are things when we buy it, we redo the signage and make sure landscaping is done, trees are trimmed, air conditionings are spaced at the right space, because I don't know how these people always stick them all close together and they can't cool, especially here in the south. They need space to cool, and the fans are competing.
Correct.
Yeah, so there's that. Yeah, so those would be some of the high points.
Yeah, no, I think that's why I think year on year you do the budgets, because you would have started off with something, and now the next year, there would be different things that would have happened. Now you got to figure out where the allocation is going to go and how things can be done more efficiently and so on. So
Yeah, and it's a process to sell. So it's just like buying, but we're on the selling side now. So now the broker basically gets our financial information. He's going to put it all together, and he's going to present it, and he's going to do an OM, which is an offering memorandum, but it's basically a pitch deck, a sales deck. He's going to have pictures in there. It's going to make the property look wonderful, and generally they talk about where the property is, the details about the property, and then they talk about the market to get you excited about the market. And they also talk about the opportunity of this property, where they think you can go with it. And then they want to compare it to other properties to see how your rents compare to others and operationally. And then basically that would be the majority of it. And then really it's about the brokers themselves. So now they're going to market it out to their people, and they have clients usually that might be interested in it. Then you're going to set up tours and have people tour through, depending on the market. If it's and the property, if there's interest, then they'll do a call for offers. If it's a really slow market, then it's just whenever someone offers, then you take a look at it. But generally, the goal is to create a demand, call for offers, get two or three in there. Like, you choose which two or three you're going to go forward with, go back to them, get them to fill out a survey, which basically is a seller's or a buyer's survey, and basically it's going to talk about who the buyers are, their experience, have they owned any in this area, how do they see the underwriting, what valuation did they come up with to get to the number that they're offering. You're just testing to make sure they understand how much capex they're planning to do. So you have certain criteria within the numbers you're going to ask to test to make sure, okay, this group is credible, or they don't know what the heck they're doing. We probably don't want to deal with them because they don't have the experience and their track record. Like, if the group has got a certain amount under management, or how much have they bought and sold, different things like that. And then once you have what's called a seller or buyer's call, and if you're down to two, you may ask then those people to put their best offer, and then you have an interview with them to ask various questions. And so that's usually with the seller's representative and the buyer's representative, and the brokerage people are in there, and they manage the call, and then the seller's representative will ask questions of the buyers, and the broker will also ask. And it's like an interview to potentially buy the property. And honestly, it could be the other way too, where they're interviewing just to see who the seller is. And if they've got a good reputation as being credible, easy to deal with, professional, that goes a long ways. And that's something we pride ourselves on. So we have a good reputation that way. So it makes it easier to buy stuff and hopefully sell stuff as well. But everyone's kind of can judge that on their own merits, whether that's a good thing, bad thing, or a certain group's credibility is good enough for them. And then really, once it's done, then you're going to sign an LOI, and then you start down the path of, 30 days, maybe due diligence, and you've got to give them access so they can do their work. And then if they come back with concerns, you've got to negotiate those, and then you go into the actual potential period where they're going to potentially buy. I'll just say, Sanjay, you know it well. No deal is ever done until it's actually the money's in the bank, so to speak.
Back. Yeah,
It's
true,
just
true.
never know what could happen. Financing could fall out. Investors, key investors, if there's someone involved, they could choose not to do it and they walk away. So you never know, but that's kind of the whole process. It usually will take 3, 4, well, right from the day you say, hey, let's sell it, to the day we're actually out of it, probably up to 6 months. It'll probably
Yeah.
take.
No, it's very emotional, right? Like when you have put in so much of your time, effort to build a community, and pretty much it's like raising a child, and now you're giving away this child, someone else. It's not only always about the money. Like, obviously we would like to sell it at the best price, but so that we can all profit from it. But it's also important that we sell it to someone who's going to take better care of this, and do justice to the amount of work that we have put in, and try to improve it even more.
It's interesting. One property that was being sold several years back now, 4 years ago, over 4 years ago, we had almost 20 offers on that. And it's interesting because that was the end just right before it kind of dried up. As was the last, like, hurrah, we'll call it. And at the time, you didn't know it, but that was just before interest rates started to go up, and they went up pretty quick. And so we had all these offers, and there was probably a delta of $2 million on this between the offers. And so within, you had some junior groups that really hadn't done much transactions, and or a couple that were first. So you kind of rate them, right? And then you've got other groups that have great amount of experience. And we ultimately chose to go with one of the lower numbers, but it still achieved 100% rate of return at that time, which was in 3 years, which is crazy because that was that crazy market time. But we went with that seller, or buyer, I should say, is because they had 1031 money. They had a lot of units. They're very credible, and they could close in 45 days.
Oh, wow.
So you weigh it out, right? Because I know in current times, a lot of sellers are upside down because of the loan factor that they did, and they're hurting. They've burned up most, if not all, of the investors' equity, and they may still be short and have to come out of pocket, or it's just they've lost all the investor income and they're trying to minimize the pain. And so therefore they're willing to go with maybe that high group, but the probability of close drops. I'm not saying it couldn't happen, but it starts to drop. We looked at it and said, we've already hit, so now you're just being greedy. Let's go with a sure bet, so the credibility to close, which we've been on the other side, having that happen for us, where people have chosen us and we've been in that lower price point. but they're still going to go with us. So there's something to that. And I would say for us, we were in that same situation where we chose that certainty over speculative because we're just locking in already. We've owned it long enough. We've hit our metrics, but we're seeing right now in the market still, and it's getting better, but we're still seeing seller here, buyer here, and trying to find that gap closing. It's starting to happen a lot more, and that's due to sellers' motivation being higher because of the pressure, or they've just had it too long, and they've just said, you know what, this is all we're going to get for it. It's time to sell it. So, and I know I started talking about that earlier, but essentially, it's interesting because buying and selling, you're just on different sides of the table. That's all. It's the same, very similar process. It's just which side are you on?
Which side do you like to be on?
I love buying personally. I love buying. It's, I'm not going to say emotionally attached because it's a transactional deal, but there's a lot of pride. You started to say there's a lot of pride in these properties. So when you go to sell them, yeah, it's got to feel that it's time, it's right to sell, and there's got to be a reason why you're doing it, other than just, hey, let's just sell it, because it's a lot of work to keep it, or at least in my books, it's a lot of work to get it where you want. And once it's where it's at, it's not a lot of work. And so it's on somewhat autopilot. And it's a source of pride to have it when they're operating well, and you're having your meetings every second week, and you're going to see it quarterly. And like, honestly, well, some of our meetings are 10 minutes long every second week, because it's just, okay, they hit everything well. And we've challenged it, and they're continuing to excel. And that's the total, like, that's the home run part of the operational part, when it's hitting that, and you go to tour it and you go, wow. You and I have been at quite a few properties where we go, whoa, this is impressive. I mean, it's just, we can't find anything wrong. And that's a true testament to that team there. And, we're very proud of them. And those that are working towards it, we're very proud of them too. And they'll get there. As you know, I'm a pretty picky person. I have very high standards. So my standards up here, if they're just slightly below, they're doing incredibly well. So, and that's a win-win for everyone.
I agree. I agree. Um, so, I think we covered quite a bit of it when it comes down to from a property perspective. So just, and obviously, all the listeners are going to learn a lot of these things that they normally don't get to learn when they're going through a mentorship or, or programs and things like that, because obviously it's a limited thing that happens. A lot of these things that you just shared is when you jump into the pool, is when you learn, you would have theoretically learned how to swim, but it's when you jump in the pool is when you start figuring out, like, hey, man, it's not as easy as it looks, right? But you did give out a lot of this information. So those who are getting started off with, they'll get to learn a lot. Our investors who always think that, oh, why is it so difficult? Why is it taking so long? Why is your K1 taking so long? Why is it not closing this soon? Right. So all of those things there, I think you answered a lot of these things, especially with the finances and so on, with the lenders. And it also comes down to, restructuring the entire property after you purchased it. It takes time and so on, because a lot of these skeletons come out of the closets even after you've done a lot of this due diligence. It takes, things do come out later on.
Oh yeah, there's always, you open up that one door and there's, oh, look at that. And it happens. Some have a lot more skeletons in there than we thought, but we're pretty good at doing our due diligence to uncover these in advance of, so that we already know, we've peeked in there. We kind of know what's going to happen. And because we've been around the block a lot, we've been doing this for a long time. So it's not a huge, but it takes time to deal with it, right? That's the key. It takes time. And certainly we're working to improve. It's interesting because we use different property management companies, and on the small properties, we have smaller property management companies, and that's fine. It's just that they have different abilities on reporting, and so we're finding we're having to get a lot more of our, I call it our professional team, our accountants, tax accountants when I'm involved to help make sure our books are where we want them. And so that's taking a bit more time, especially if you've just transitioned to a different small management group. The bigger ones, boy, they've got, the big software. You can manipulate it all different ways. So we just kind of give them a sense of what reports we want because we know what we like and the format associated with it, and they'll be able to create it for us. So we're pretty happy with it. We don't have a lot of work, but we're still analyzing it, as I said before. But the smaller ones take a lot more energy, it seems, to get it where we want because they just don't have the same capability. And once we get them trained up and we get these financials set up, it's like clockwork. But boy, it's sometimes dragging, unfortunately, and that's an area of improvement. I think we can work on for sure to get that smoothed out better on that side. So I mean, we're always looking for improvements, and so if we were perfect, it'd be boring, right? You want
Absolutely.
challenges.
No, I think it's all about continuous improvement, right? Like there's no such thing as perfection because every time you perfected something, you see a little bit of imperfection in it because now you got to, you see, oh, we could have improved the efficiency by doing a little bit like this or a little bit like that. So we always raise our bar, right? So that and every time when you raise your bar, you got to make some improvements to it to make that change. So that's
Mm-hmm.
just part of I think growing as well. So,
Yeah.
but one of the things that I've noticed that a lot of people, don't see it is about you. I would say is that you know you're always focused on, as you said, you look at all the smallest details. Like for example, when we walk to a property and you see even one thing that is not in its place, like for example, it could be as simple as a trash can or it's not positioned right. I've seen how it just bothers you, and then you just go there and you yourself go and pick certain things, or you make that move, and then and you see that the property manager is watching it, right? And it's like, so now you're setting as well by pretty much saying like doing expecting them to do it without telling them to do it by your actions. So those are the small
Yeah.
subtle things, that makes a
Yeah.
lot
I
of
never ask anyone to do
difference.
anything I'm not prepared to do myself. And certainly when we see something, I have no fear jumping in to do it and get it done. And you're right, you lead by example. So very, very true. And I think it just helps set the tone for everyone. And then that's yeah, and they know if they need help, I'm there for them. I'll if they're having trouble with something, we'll make it work. I'm happy to come there, or you'll go there. Like we support the team, but yeah, I mean, yeah, because at the beginning, sometimes people don't understand how important this is. Like I'm pretty picky, but this is what helps make a great community. For instance, we were at one property, we had the fireplace area, right? Fire pit area, and there's some broken chairs. And so, I didn't see anyone else grabbing them. And so I grabbed them and took them to the garbage can and threw them out. And they said, order some new ones, order extra and keep them in our maintenance shop so that if one breaks because they could, you've got a spare one to change it out because we want to make sure those are representative of the property. And yeah, so I mean, it got the point across. There was another time when we were about to change management companies where there's a whole bunch of, tends to be when you move at the end of the month, there are people that move and you end up with a lot of excess garbage that maybe doesn't fit in the bin at the time. And so then the bin gets emptied out, but who puts it in? And I happened to be at the property at that time. You were not with me this time. And so I just said, this isn't acceptable. And I started throwing it all in. That's fine. I just who I am, and if I'm there and I see it, or if I'm walking past garbage and I see it, I'm going to pick it up and I'll throw it away. it's interesting, Sanjay, with the C properties. Initially, when you buy them, you've got garbage cans, and typically the garbage, some of it makes it, but a lot of it makes it to it almost, but it's scattered around the garbage can. B properties, you're going to see a higher percentage where the garbage is making, but there's still some. A properties, generally, they're always in. It's very rare you see any. But when we have really done a good job, we see very little garbage at our C properties because people take pride in it and they make it in to a garbage can. And when I see it, it's the old adage. If you go back to the manufacturing days, if you've got a really tight, clean operation and you see something out of place or garbage, it's really noticeable. It's the same on a property. If it's really clean and tight and there's some garbage, it's noticeable. But if there's full of garbage and you add one more to it, doesn't make any difference, right? So we want to be on the other side where one piece of garbage is very noticeable and someone will take pride. And we have a lot of people helping us at the property because they take pride. And I think that's pretty special. I'm very proud of that.
And yeah, I've noticed that. I think that's one of the key things that a lot of people do ask me this question many a times, like, what is it that you guys do different, right? Because I travel with you so much, I get a lot of questions because everybody wants to be like Jim, right? So they're like, Sanjay, you travel with them so much. Like, what would Jim do? I'm like, okay, this is what, this is how it happens. And yes, I think going there often, I think once every quarter, I've seen operators who have not gone for like a year to the property, right? They see whatever through the eyes, lenses of the property management company, whatever they are showing them. But going there on a quarterly basis definitely helps. Doing this, weekly calls with them and actually putting in the parameters and, you know, the preventive maintenance, hiring the right kind of maintenance guys. I think you hit a very valid point is that, um, maintenance is the key. And when you have done a good job of preventive maintenance, uh, not only the costs come down, things don't break as often, but also, the tenant is happy because they don't have to call someone to keep fixing it very often.
Yeah,
The maintenance guy is also very happy because he doesn't have to, instead of putting up a new HVAC, he now has to just tinker around and fix whatever is necessary and keep it running. So
yep,
those things are key. Hiring the right kind of maintenance guys is also a big part of this as well. Even though a lot of people don't understand, is that they always believe that the property management has to take care of it. It's not our business, but in true essence, it's our business to make sure that they are hiring the right kind of people and running the ship, a right ship, the way we would want them to.
absolutely. But we're one big team still at the end of the day. But
Absolutely.
but we're definitely working with the team to make sure we're all hitting what we want. But yes, I agree 100%. We want to make sure they're successful, and we've defined what success means. By having that definition, it's clear to them what we are looking for, but it's clear what the team needs to achieve in order to be successful, and that's so critical. And it's a team event, a team sport here. Is it's not an individual, like we have certain sports where you can have one person that's trying to, they call it cherry picking, where they're trying to just hog the ball and be that one person. And we can't, it can happen, but we need everyone to help each other here. And so we're helping facilitate them be successful and making sure they have what they need to be successful, but they know what success is absolutely imperative. It's usually when they don't understand that and they don't have the support, failure can creep in very quickly.
Yeah.
Yeah,
So, Jim, a lot of people learned a lot about you, a lot about the real the real estate market, especially the multifamily side of things. So, a little bit about Jim itself. Like, what's Jim's favorite book to read?
oh, you know, I must admit, lately I haven't read like a fun book, but I read a lot of information that me know what's going on in the market. But in terms of fun books, it's been a little while. I need a holiday. And the last holiday we did, we were touring Europe, so that wasn't the time to be reading a book. We're not on a beach necessarily. But if I was to read a book for fun, it's going to be have a lot of funny comedy in it, and it's like the movies I like the same way, where it's going to be light and funny and chuckle out of it, and or it's a biography. I enjoy biographies about people. What can we learn from what they've done? In the early days, it was Earl Nightingale way back when, and Lead the Field was probably one of the very first books and cassette tapes I ever listened to. Of course, Tony Robbins came later, but those things really helped shape me when I was young. And honestly, having the laser focus is really what can define a person, where you've got your goals set, short term, midterm, long term, and you've got a vision or white paper. It could be a vision board or white paper, and so you're clear in your mind what that's going to be. And then that allows you to then be focused. And at nighttime, I like to get rid of the tasks, like the actual tasks, and have those listed. So those are out of my mind. And I like to think about what really is driving it forward. And I let my subconscious work on it through the night and be surprised in the morning. I can't answer how it happens, but there's a lot of progress, we'll say, because subconscious has worked on it while I've been sleeping, and help solve or come up with solutions. There's the signal noise ratio, and I've been a big believer in that. I talk about that laser point and having that straight focus as to where it is. And when you're focused on that, all of a sudden, all this other stuff, this noise becomes really low, and so that becomes high signal, meaning the high task, high driving towards where you want to go. And if you can get your signal up high and keep the noise distraction down low, you can achieve an awful lot. And it's okay to say no, because you need to say no in order to stay focused. It's no, now's not the time. In our business, it quite often means, hey, what about student housing? What about storage? What about, lately it's been RV parks, or what about oil and gas wells, or whatever it is. And if that's not in your strategy, you need to say no. Now, if your strategy is not working, maybe you need to revamp it and then open it up. But what does happen is, with that focus, is the right things come into your life. All of a sudden all of a sudden now you notice the right things, and it helps excel you towards where you're trying to go. And it's worked well for me over the years. And so I just say, for me, that's been my formula. But others maybe have a different way to work. But that's, and Lead the Field was one of the first to go back to that. And the top word was attitude. You got the right attitude, everything else follows below it. And I still remember that, and it's cherished. And then you get into other sort of strategies like that with other books that were in that era. So yeah, so that. But today, I will admit, I am trying to enjoy. Like, I'm leaving shortly to go visit with my daughter in Scotland and tour around. So, I will say, when I'm flying over there, I'm going to probably watch, because I don't watch much TV or TV shows or whatever. I'm going to pick up a few movies and catch up on all the movies I've not seen. So
So which
there's
are
some
your favorite
great
movies that
comedies.
you have on your, which are the movies that you want to watch while you're there?
Well, mainly, I love laughing. So I think having good laugh is always fun to have it. But I also like the action. In His Day, Born Identity, stuff like that. It was fast move. I love the action movies too. So it's a toss up. Those intense
You're into
thrillers.
cars, so Fast and the Furious would be one of them.
What's that?
I said you're into cars, so Fast and Furious series would be one of them.
Yes. Well, sure. Yeah, I've definitely seen those over and in the theater, and Mr. Cruz his movies are great on the big screen. So don't go to the movies often either, but when I do with my wife, it's really enjoyable. Yeah. So, but typically I am reading still more for information purposes as opposed to just like fiction and whatnot. My three beautiful ladies in my life are ferocious readers, and they read a lot of fun books. So there's lots to choose from, and every so often they say, "Hey, Dad, check this out." So I will do that. And although nowadays it's not a book, it's a Kindle reader or whatever, or on the iPad sort of thing. So yeah.
Awesome. Thank you, Jim. I really appreciate you getting on REI Secret Spill Fast Track to Riches. As always, I learned a lot. I learn something new every single time when we meet, and I look forward to meeting you again. On our next trip, and we'll have some more discussions over there, and plan another podcast for that one as well.
Or we can talk about maybe you trying to speed again or something and getting pulled over.
Absolutely, and get pulled over. There you go.
Yeah, and then driving the other way slow.
Those are some fun moments we had getting pulled over.
We had a lot of laughs.
Oh, yeah. And a lot of laughs, yeah. And the cop getting all confused. There are two brown people, one white guy. Maybe these guys are kidnapping him, so on. So. Yeah, some great things. So, all those
been a lot of
people
fun.
There.
A lot of early mornings as well, right?
Yeah.
So I'm trying to keep out of the sun here. It keeps sneaking through our blinds, but anyway, a lot of early mornings and beautiful sunrises or the sunsets. We've packed a lot in, usually in a small amount of time, which is great, and we've had a lot of great meals with a lot of folks in different cities. We've been able to meet up with a lot of great people, and it's a lot of fun. I really enjoy this business for all that side of it, getting to meet great people in different locations and creating these friendships all over the place. It's one of the great benefits of what we do, and then of course there's all the teams we work with as well. There's a lot of great teams, so we've met a lot of great people over the years here, and so I don't plan to slow down at all. I'm loving what I'm doing, so why would I until the point I can't do it anymore.
No, my wife always keeps telling, I don't know if you're working or you're just partying. Which one is which? Because you're never home. You're having fun. You're always meeting new people, and you call it work. So for her, it's not work, right? It's like it's fun, which to me is fun too. You don't feel like it's work while you are enjoying what you're doing.
It's and partying isn't really in my vocabulary. I mean, compared to what it might have been meant in the 20s, but meeting up for people, having a great dinner together, and that's a lot of fun.
That's exactly how they look at it.
It's been very blessed to be able to do all this, and also provide for the family and have a great life for all of us, and then give back to others. I mean, it's pretty humbling to be able to have all that. So I'm very blessed.
Yeah, no, same here. I feel very blessed. I have you in my life, Jim. Thank you very much for being a partner, being a mentor, and helping me, getting my start and everything. So greatly appreciate you also taking the time to get on the podcast today. So thank you very much. And if someone wants to reach out to you, Jim, how can they reach you?
Well, they can go to the website, westkeycapital.com. So westkeycapital.com, or email is Jim Stewart, and Stewart is spelled Stuart, not the EW, so Stuart. So Jim Stewart at westkeycapital.com. Probably be the easiest way, or you can also find me on Facebook, probably, potentially, or on LinkedIn as well. There's those sides of it. And yes, I don't have the background with my name on it and whatnot. I've got the die-cast cars that I wish I could add water to and become all full-size cars. It'd be great to add to the collection that way. So yeah, but yeah,
Awesome.
that'd be their best way to get a hold of me.
No, definitely. We'll definitely be adding your contact information in there as well when we send out the podcast. So all those guys who are listening to this, you will be seeing this in different, because it was a pretty big segment over here. Because I think we could have carried on for another couple of hours if we really needed to, because Jim is a wealth of knowledge and there's so much he knows. And I try to pick a little bit every single time when I travel with him. So you guys really kind of got a gist of how Jim and I make our journey when we travel 2 hours, 3 hours on our driving around. So this is pretty much what it is. It's just a small piece of it, but yeah, we'll be doing more of it. And if you have any questions about anything, just do let us know, because that's what we're here for. As Jim said, we like to share our whatever knowledge we have and help everybody grow. So thank you very much, Jim.
Sanjay, thank you very much for having me. Glad to have you as a partner and a friend. So very blessed, and so it's been great. And for those that listen to this whole thing, thank you for sticking it out, because this has been a long podcast. So thank you.
Thank you.
Have a great day. Bye.